Hello, everyone. Welcome to the Financial Mini Lecture. Have you noticed that this year many people around you who are planning to buy homes are discussing news about declining mortgage interest rates? Some students may also have heard that their parents' deposit interest rates have changed. These financial phenomena that are closely related to our daily lives are all driven by the monetary policy regulation of the central bank behind the scenes. Today, we will take an in-depth look at the financial regulator that influences economic performance and everyday life, conventional monetary policy instruments. First, let us clarify what monetary policy instruments are. Simply put, monetary policy instruments are specific measures adopted by the central bank to achieve macroeconomic objectives such as price stability and economic growth. They are like the prescriptions a doctor uses when treating the economy. Through these instruments, the central bank regulates the money supply and interest rate levels in the market, thereby influencing the overall pace of economic activity. According to differences in scope and effectiveness, monetary policy instruments can be divided into conventional instruments, selective instruments, and others. Today, we will focus on the conventional monetary policy instruments, known as the central bank's three major tools. Conventional monetary policy instruments mainly include three categories: the reserve requirement policy, the rediscount policy, and open market operations. Let us analyze them one by one. One, reserve requirement policy. Required reserves refer to the funds that commercial banks are required by the central bank to deposit in their central bank accounts at a certain proportion of the deposits they absorb. This proportion is known as the reserve requirement ratio. After accepting public deposits, commercial banks use most of the funds for lending in order to earn profits, but they must retain a portion as reserves to meet customers' withdrawal needs. When the central bank adjusts the reserve requirement ratio, it directly affects the lending capacity of commercial banks. Raising the reserve requirement ratio reduces banks' lendable funds and contracts the money supply in the market. Lowering the ratio increases banks' lending capacity and enhances market liquidity. However, this instrument has a strong impact and is therefore known as a strong medicine in monetary policy, requiring great caution when adjustments are made. 2. Rediscount policy. When commercial banks need to convert the commercial bills they hold into cash, they can apply to the central bank for discounting. This process is known as rediscounting, and the discount rate set by the central bank is called the rediscount rate. This is essentially the cost for commercial banks to borrow money from the central bank. When the central bank raises the rediscount rate, the borrowing cost for commercial banks increases, prompting them to reduce borrowing and thereby contract credit expansion. Conversely, lowering the rediscount rate reduces borrowing costs and encourages commercial banks to expand credit. Compared with the reserve requirement policy, the rediscount policy is more flexible, but its effectiveness depends on the willingness of commercial banks to cooperate. 3. Open market operations. This refers to the central bank's practice of buying and selling government bonds and other marketable securities in the open market in order to regulate base money. When the central bank purchases securities, it injects funds into the market. When it sells securities, it withdraws funds from the market. The advantages of this instrument are very clear. The central bank can conduct frequent and continuous operations in response to market conditions, and it can fine-tune the money supply with precision. As a result, it is currently the most widely used conventional monetary policy instrument by central banks around the world. To help you better understand, let us analyze a real case from China in 2025. According to the report on the implementation of China's monetary policy for the second quarter of 2025 released by the People's Bank of China on August 15, 2025, in order to create an appropriate monetary and financial environment for economic recovery and improvement, the central bank adopted a moderately accommodative monetary policy, strengthened countercyclical regulation, and comprehensively utilized various conventional policy instruments to serve the high-quality development of the real economy. In terms of the reserve requirement policy, in May the central bank lowered the reserve requirement ratio for financial institutions by 0.5 percentage points, excluding institutions already subject to a 5% reserve requirement ratio, providing approximately 1 trillion renminbi in long-term liquidity to the market. This effectively enhanced the credit supply capacity of commercial banks and injected long-term funding vitality into the real economy. In terms of interest rate adjustment, the central bank simultaneously reduced the policy interest rate by 0.1 percentage points in May, lowered the interest rates on structural monetary policy instruments by 0.25 percentage points, and reduced personal housing provident fund loan interest rates by 0.25 percentage points. Through multi-level interest rate adjustments, deposit and lending rates declined across the board. From January to June, the interest rates on newly issued corporate loans and personal housing loans fell by approximately 45 basis points and 60 basis points year-on-year, respectively, significantly reducing financing costs for enterprises' production and operations as well as for residents purchasing homes. In terms of open market operations, the central bank continued to conduct regular reverse repurchase operations and persistently carried out outright reverse repurchase operations to supplement medium and long-term funding gaps. From April to June, operations amounted to 1.2 trillion renminbi, 700 billion renminbi, and 1.4 trillion renminbi, respectively. By the end of June, the outstanding balance of outright reverse repurchase operations reached approximately 4.6 trillion renminbi, an increase of 1.9 trillion renminbi compared with the end of the previous year. In addition, 7-day reverse repurchase operations were conducted as needed to maintain stable conditions in the money market at the mid-year point. By the end of June, broad money supply, M2, grew by 8.3% year-on-year, and the outstanding stock of aggregate social financing increased by 8.9% year-on-year, creating a suitable monetary and financial environment for sustained economic recovery. Finally, let us summarize and review today's content. In this lesson, we first clarified the core concept of monetary policy instruments, and then focused on the three major tools of conventional monetary policy: the reserve requirement policy with strong impact, the rediscount policy with greater flexibility, and open market operations that are flexible and precise. The practical cases and authoritative data from China in 2025 demonstrate that the combined use of these instruments can effectively regulate the money supply and interest rate levels, thereby safeguarding the development of the real economy. We hope that in the future, you will learn to analyze economic phenomena in daily life from a financial perspective. Thank you for listening, and see you in the next class.